Hello everyone, and I wanted to talk about flexible budgets today. This is essentially the lecture that I tried to do on Friday, February 28th. So for those of you that missed class because you were out of town, this is a chance for you to catch up on that information. And so a couple of things you need are going to be the handout we had for this particular chapter that includes the problem I'll be working, and then also a template that I'll put out there on Canvas as well that you can follow along with as you complete the this lecture. So that's the strategy we have today, and we'll go from there. So the flexible budgets, the thing you have to remember is we're really starting from our old friend SV Company. SV Company, and then our units, our per unit, and the totals. So this is something you already know how to do, and we're just building off of that capacity. So that's where we're going from here. And so in this particular problem, you're told right away that we have finished units of 10,000. Okay, so in this problem, you'll see 10,000 come in here. So I have 10,000 in units. Now it's really important that you remember these are finished units, which means they're complete and ready for sale. They are finished saleable units. Okay. Then we also know, it's given in the problem, that our sale price for these units that we anticipate are going to be 200. And so once I know that, we know from our little SV Company that our sales, we expect our sales to be 2 million. Okay, so that's our sales line. Remember that when we set up this original planning budget, okay, the idea was that this is a forward look at from one point in time. So when we originally did this, we said we can sell $10,200 a piece for 2 million. You can equate this back to the part 2 of the project that you did when I asked you to do this kind of income statement. Okay? Now, the next thing you would do is I've always given you some sort of fixed variable expense per unit, right? So if I gave you variable expense per unit, we're going to call it 154. And I'll show you where that number comes from in just a minute. So if I know that number, I'm also going to know that. And at that point, I also know my contribution margins. Don't forget, you've got a contribution margin percentage and a contribution margin per unit. Okay? Remember, those are going to be constant between your flexible budget and your planned budget. And then finally, you're given in the problem that the fixed expenses were 250,000. And so as a result, I'm going to have an income number of 210. And at this point in the semester, that should be an easy setup for you in terms of the way you put these variable costing income statements together. Now the challenge you have is going to be this 154. Where did that thing come from? Well, it turns out that instead of just a single number called variable expenses, there are different pieces that can be in there, or what I call the recipe. I mean, if I was going to bake cookies, I would have a recipe to know what are the things that go into the cookies. Here I've got things that can go into, or I need to make these 10,000 units. And those things include the direct material, the direct labor, and the variable overhead. Okay? Remember, these are all variable expenses. And so you got to be a little careful here about the difference between the resources and the finished units. So those are going to be two things we'll talk about here in just a second. So in this problem, it's given to you in the problem itself that it's going to take 10 yards of material to make a finished unit. Okay, so I'm selling in this problem window covers, so maybe 10 yards of plastic to make the window covers, and so I've got to buy 10 yards. That'll allow me to make the final the finished units. Now this also equates back to that direct materials budget that we did. Remember how we had sales at the top and we converted that into the units we needed to buy, and so we had the total amount that we needed to purchase. Well, here's the 10 that we've got to have. And here, also in the text of the problem, it tells you that the price per yard is $8, and as a result, the total cost of a finished unit is going to be $80. So it's the 10 times the 8 is going to equal the 80. Now it's important that you distinguish between resource units and finished units, and don't get mad at me for the abbreviations. Okay, so resource units per finished unit, RU, and then the price per resource unit, then overall the cost for a finished unit. Okay, so make sure you keep those things straight. Also in the problem, you get the information for labor and overhead, and as a result, when I add those up, I get a price or a total cost of $154. The 80 plus the 54 plus the 20 give me the 154, and that's the same 154 I had up here. So all you're seeing here is that total variable expenses are broken down into 3 components, and that's going to be an important part. And so that's our original planning budget. So that's our planning budget. The only thing that changes, okay, when I move into a flexible budget, the only thing that changes is going to be that number right there. So instead of my original plan of 10,000, my actual sales now, and it's given to you in the problem, are 12,000. And as a result, my income goes up because my volume went up. But remember what I said, okay? The original assumptions stay the same. So the 200, the 80, the 54, the 20, the contribution margin per unit, and the contribution margin percentage all stayed the same. Also, that fixed expense stayed the same. So the only difference is going to be the difference because of volume. And that's the difference between the 210 and the 302, because these parts are constant. All right, well, that's what we need to get done. That's what we covered on the Friday afternoon and the Friday morning classes. So we'll look for more next week. Take care.